Hi, everybody. This is Peter Schiff. It is Monday, June 24th, 2013. Well, earlier last week, Ben Bernanke sent shockwaves throughout the global financial markets by suggesting the possibility that quantitative easing might end in the middle of 2014. What exactly did Ben Bernanke say? Well, he said that he believed that the U.S. economy was recovering and that the risks to the recovery had subsided. He also said that if he's right, which again would be a very rare occurrence because he's really never been right when it comes to forecasting the economy, but if for some reason this time he happens to get it right, then at the end of the year, he's going to begin tapering back the size of the QE. In other words, he won't buy $85 billion a month of mortgages and treasuries. He'll buy somewhat less than that. He didn't actually say how much less. Then he said, if that doesn't have a negative impact on the recovery, if the recovery continues to progress, then he will continue to taper off his quantitative easing. And if everything goes perfectly, well, maybe he will finish quantitative easing. In other words, he'll keep tapering it off until by the middle of 2014, there won't be any more quantitative easing. But of course, all this is a fantasy. Maybe it's in Ben Bernanke's dreams that he's able to achieve this. But I don't think he's going to be able to do it. Maybe he thinks he's going to be able to walk across the Grand Canyon on a tightrope. He's not that dexterous. He doesn't have that kind of a skill to pull this thing off. And of course, even though he's suggested the remote possibility that he would end QE. And I say remote because in order for it to happen, Ben Bernanke would have to be right in his forecast of the economy. But even though he said this, he was trying his best to reassure everybody that it wasn't the end of stimulus. He used the car metaphor. He said, no, we're not going to step on the brake. Don't get me wrong, we're not stepping on the brake. We're simply easing up on the accelerator. That the Fed was still going to support the economy, even though, according to Ben Bernanke, there's a recovery. If there really is a recovery, why does the Fed have to support it at all? He didn't answer that question, but he said that the Fed's going to keep supporting the market. He said that even if we stop QE, that doesn't mean we're going to raise interest rates. In fact, Ben Bernanke said that the first rate hike might not happen for a couple of years. And even then, even when the Fed begins to raise interest rates, maybe they go from 0 to 25 basis points, he assured everybody that it would be a very, very slow increase, that the Fed would be very, very cautious and rates would move up very, very slowly. So in other words, he tried to reassure everybody that the cheap money was going to keep on flowing. In fact, at no point during his press conference did Ben Bernanke talk about actually shrinking the balance sheet. Remember that talk about an exit strategy? There's no talk about exit. There was no talk about the Fed actually selling any of the bonds that it owned, any of the mortgages, just a reduction in the amount of bonds or mortgages that it was buying. And then that reduction was totally subject to the Fed's interpretation of the economic data. Again, he didn't even give any concrete numbers. He left it all open because it's my opinion that Ben Bernanke has absolutely no intention of following through on that commitment to taper. He knows, I believe, that the recovery is not real, that it is completely dependent on quantitative easing. But I think that Ben Bernanke felt compelled to let the markets know that it wasn't QE infinity. That at some distant point in the future, if the economy were strong enough, that they were going to have to end quantitative easing. That's all Ben Bernanke set out to say. But I think Ben Bernanke underestimated the size of the bubble that he probably doesn't even know exists. I think that Ben Bernanke inadvertently pricked his own bubble in the bond market. Even though he didn't actually take out the pin and puncture it, merely discussing the existence of a hypothetical pin and the fact that he may one day use it, I think that's all it took. This bubble was so big, there's so much air in it, it's been searching for a pin for so long that I think it found one. And I think Ben Bernanke, bit off a lot more than he can chew. In fact, he mentioned in the press conference that he was perplexed by the increase in interest rates, and they've increased a lot more since he confessed his confusion. Well, I think the Fed is very, very nervous about what's going on because I believe that interest rates are going to keep rising until the Fed basically reverses policy. The Fed is going to have to cry uncle, surrender, and give the market what it wants, which is more QE, not less. I think that's what's coming. I think everybody who's now expecting tapering is going to be surprised when they find out that the next move that the Fed makes is to increase the size of its monthly QE, not to diminish it. The $64 trillion question is, will it have any effect on the bond bubble now that all this air is coming out of it? You see, Ben Bernanke's recovery is based on the foundation of rising asset prices. The stock market, and in particular the real estate market. Ben Bernanke, in his press conference, was very clear in his belief that the real estate recovery was underway. He even said that rising interest rates, mortgage rates, wouldn't detract it, that real estate prices would keep on rising. Now, considering how poor his track record is with respect to the real estate market, you would think he'd be a little bit more humble and basically confess that he has no idea whether or not the real estate market is going to keep appreciating. But I think the irony of it is the real estate market might have already seen the highs as Ben Bernanke was declaring, everything was, the worst was over, that the market had already topped out and that we were heading back down. Remember, a lot of the buying in the real estate market is speculative buying. It's hedge funds, it's private equity funds. I think a lot of these buyers were hoping to cash out by tapping into the equity markets, by maybe securitizing these homes into residential REITs, single-family home REITs. Well, the bottom is dropping out of that market. If you look at the market for higher-yielding assets, it's imploding. I mentioned on my radio show about a month ago that you could get a loan to buy an RV. An RV, a 20-year loan at 3.99%. It's that kind of crazy credit that was driving the markets. The same thing with automobile sales. Anybody who could fog a mirror was able to qualify for an auto loan. We had a big subprime problem because everybody was chasing yield. Everybody was taking on lots of risk thanks to the Fed. Well, now the Fed is indicating that it may not be there indefinitely, and people are already starting to try to take money off the table. Everybody's trying to do the same thing at once. The bottom is dropping out of the market. So what's going to happen is the wealth effect is now going to work in reverse. I think the real estate market is topped out. It's going down. The stock market now is topped out. It's in a correction. And all of that wealth is vanishing, or that paper wealth. And now people are not going to spend money the way they were because they're going to realize they don't have as much money as they thought. Meanwhile, the cost of making a mortgage payment is going to go up if you've got an adjustable rate mortgage. And credit is going to be more expensive throughout the economy, not only for individuals, but for the federal government. They're going to have to pay higher interest rates to finance the deficits that are now going to get bigger. The deficits were shrinking a bit when the economy was quote unquote expanding, but now that the Fed has set off a contraction, now the budget deficits are going to get bigger. The federal government was getting a lot of money from Fannie and Freddie because they were temporarily making profits. Now they're going to have losses. They're going to be sending the government a bill for those losses. So the budget deficits are going to get bigger. The consumer confidence is going to fade, and the jobs are going to go. A lot of the jobs that were associated with the reflating housing bubble are going to vanish, and the banks are going to start laying people off. I think the auto sector is going to lay people off. The housing sector is going to lay people off as consumption contracts. Retail services start laying people off. A lot of these jobs that were created as byproducts of the reflating bubble are going to disappear as the air comes out of it. So the very recovery that Ben Bernanke confidently proclaimed was self-sustaining is evaporating even before he's able to dial back the stimulus. Now, what do I think is going to happen? I think that there's going to be continuous downward pressure on the bond market and then the stock market until the Fed does something about it. Because after all, if the Fed was basing its optimistic assumptions on rising asset prices and those asset prices are now falling, what if the stock market goes back into a bear market and real estate prices are headed for new lows? He's got to totally reassess his evaluation. In fact, if I'm right, the unemployment rate is going to begin to uptick. Right now, I think it's 7.6%, the official rate. Of course, unofficially, it's much higher than that. And a lot of the jobs that we do have are people working part-time who would rather be working full-time. And most of the improvement in the unemployment rate came because people left the labor force, not because they found jobs. But some of the jobs that people were able to find are going to disappear because they weren't sustainable jobs. And so as the unemployment rate heads north, Ben Bernanke is going to have to do something. Now, whether he waits for the data to confirm that the U.S. is headed back to recession, or whether or not he can connect the dots himself and he tries to act preemptively by rescuing the bond market, how is he going to do that? One thing he can do is announce an increase in the size of QE, that the Fed will buy more than $85 billion a month in bonds. And obviously, if he does that, then any tapering is pushed off even farther into the future because the Fed has increased the QE. It would have to taper it back just to get back to the $85 billion where it's currently. Another thing the Fed might try to do is actually draw a line in the sand when it comes to interest rates. Pick a point. I don't know what that yield is. Right now, the yield on the 10-year is a little bit above 2.5. It got above 2.6 at one point today. But maybe the Fed says 3% is our line in the sand. We will not allow Treasury yields to rise above 3%. And they'll have to print as much money and buy as many bonds as they have to defend that line. Maybe they do that. But whatever they do, right, when the Fed admits this, then it should open up a lot of eyes around the world to the extent that it is QE affinity, that the recovery is not real, it is completely dependent on the Fed, that the Fed doesn't have an exit strategy, it never did, and it never will. It would be an admission of the Fed of the box that the U.S. economy is in and that we have to continue to print money. People still hold on to the illusion, and I hear this analogy all the time, including today, that QE are the training wheels and the Fed is just taking them off. It's not the training wheels, it is the only wheels. And the Fed may bluff about taking them off, but they're never going to do it. But that doesn't mean they should leave them on because, as I've said over and over again, we are bicycling towards the edge of a cliff. And we're going to go over that cliff if we leave these QE training wheels on. But the Fed is going to leave them on. And the fact that interest rates are already rising proves this. Now, what is going to happen when the Fed has to come out and reverse course and admit that we need more QE, not less? That should be, again, a big story in the market. It should knock the legs out from under the dollar, which, by the way, has rallied a little bit during this so-called flight to quality, but not as much as many might have expected, given the rout in the global stock markets and in the bond market. But such an admission should knock the support out from under the dollar, and the gold market should finally reverse this bull market sell-off that we've had. We've had a big correction in the gold market, again, because gold traders have misinterpreted the U.S. recovery as being genuine, and they believe that Ben Bernanke is actually going to tighten, even though he hasn't said that he would. He simply made it conditional on things happening in the economy that are not going to happen. But when the gold market wakes up to the fact that there is no tightening, there's just endless easing, that we just have one big bubble, then I think you'll have a mass scramble on the part of everybody who sold their gold to buy it back. Where they're going to get it, I don't know. Who's going to be sellers at these levels once that moment happens, once people figure out that they've made a mistake? I don't know. So I would expect to see a very, very rapid rise in the price of gold. What is a little bit harder to gauge is what will the immediate reaction be in the bond market? Will the Fed coming to the rescue of the bond market with more QE, will that cause a rally in the bond market, at least a temporary rally, or will that simply throw gasoline on the fire that is already burning? After all, you've got a lot of private owners of U.S. Treasuries. And right now, the yield on the 10-year at 2.5, there is no reason to own a Treasury at 2.5. The only reason to own them before is because the Fed was there. The Fed was buying. It was a bull market. Prices were going up. The yield wasn't enough. It was the possibility of appreciation that was the driving force behind the inclination to buy. But now that the bond market is falling, why would you want to buy a 10-year bond yielding 2.5% if you think the price of the bond is going to fall? What if you think bond prices could drop by 10%? Are you gonna risk losing 10% of your principal to make a 2.5% return? No. So I don't even know how many bonds. 125 billion a month, 150 billion a month. That's probably not going to be enough to turn the market. And remember, the budget deficits will be increasing as rates are increasing and the economy is slowing. So the Fed will not have to just buy all the bonds that everybody in the private sector wants to unload, but it also has to keep buying all the bonds the U.S. Treasury wants to sell to finance its deficits. So even if we get a short-term rally in the bond market, it's not going to be long-lived. You know, we finally got the Bank of International Settlement to come out, and they put out a report that reads very much like what I talked about the Federal Reserve's Advisory Committee warned. It reads very much like what I've been saying for the past several years, where you've got the Bank of International Settlement basically coming to the conclusion that QE hasn't worked, that it's exacerbated the very problems that they were trying to solve. Well, duh, that's what I've been saying for years. The problem is, for years, the Bank of International Settlement has been another one of the cheerleaders urging the central banks around the world to do exactly what it's now criticizing. Maybe now that the wheels are about to come off the bus, they want to at least be in a position to have said, well, we told you so, but it's too little too late. But if you read that report, again, it's like it's the same things that I've been saying for years, although I saw a representative of the Bank of International Settlement on television basically trying to sugarcoat what was a very, very disturbing message, or should have been, that the central banks have simply enabled governments to run bigger deficits at the expense of addressing the underlying structural problems, that we simply postpone the day of reckoning. Instead of improving our balance sheets, they're now worse. We haven't restructured. We haven't done the things that we need to do. The central banks have just bought us time, and it was very expensive because we squandered the time. And instead of fixing our problems, we made them bigger. And now the pain associated with fixing them is going to be much bigger than had we fixed them initially. In any event, I think that we potentially could be on the verge of another Lehman Brothers moment in the markets. And what's amazing to me is if you go back to the period in 2008, just before the financial crisis, and you look at the extreme levels of complacency among all the financial experts who were saying it's a good thing, it's a correction in the stock market, it's a buying opportunity, the markets are sound, real estate is sound, nothing to worry about. You're hearing the same stuff today. This is a healthy correction. Interest rates are going up for the right reason. Interest rates are just returning to normal. This is a good thing. It is not a good thing. And even if interest rates were to return to normal, that doesn't mean that we can afford them. Because how can you afford a normal rate of interest when you have an abnormal amount of debt? That is the problem. The only reason the U.S. economy has been able to service all of this debt is because interest rates have been abnormally low. They've been as low as possible. The fact that they're now rising is going to mean we're not going to be able to service this debt. So historical precedents that took place during normal periods of time, I keep hearing people on television talking about the days where we had 9 and 10% mortgages, saying that, hey, we were able to have them back then, so why can't we have them now? We can have them now. It's a different economy. We're broke. We don't have the money. We don't have the resources. And real estate prices are much higher now relative to our ability to pay. The only thing that's keeping anybody in the game, other than government guarantees, which are, I don't want to undermine the importance of Fannie and Freddie and government guaranteed mortgages and low down payments, but they also need low monthly payments, and that's coming from the Federal Reserve. And we also need the speculative buyers and the hedge funds, and that's coming from the flood of cheap money that the Fed is now hinting it may be willing to withdraw. So this could be the beginning of a much, much bigger decline. The real crash that I wrote about not only in my most recent book, The Real Crash, but the original book, Crash Proof. The main difference that I see between the crash that's coming and the one that we had in 2008, other than the fact that it's going to be much bigger and have much more profound implications for the U.S. economy, is that it should also be a crash in the dollar and in the U.S. bond market, something that did not happen in 2008 when the dollar and the bond market rose. And also, back then, the price of gold went down and the price of gold stocks crashed. Well, gold has already gone down and gold stocks have already crashed prior to this crisis. So I think it's set up to have an opposite reaction in the gold market as well, as people rush out of bonds or stocks into gold or gold-related equities that have already sold off based on the false premise that the U.S. economy is improving and that the Fed is about to end QE. The fact of the matter is we're on the verge of an even bigger recession, and the Fed's about to go all in on QE. That's it for now. I'll keep you posted on what's going on my video blogs. And remember, to get the day-to-day coverage of what's happening in the markets, don't forget to watch my daily radio show, The Peter Schiff Show, at schiffradio.com. I do it live every weekday from 10 a.m. to noon Eastern Time. Again, it's schiffradio.com. Bye for now.